Hello, welcome to Diamond's Edge Live. My name is Greg Diamond, editor of 10 Stock Trader at Stansberry Research. And this week we're going to take a little break from our normal routine, our normal live show. And I'm just going to continue on with a little bit of educational content, kind of overlooking different ways to look at the market from a technical perspective. I'm going to look at different technical patterns, flags, pennants, wedges, triangles. We'll look at candlesticks pattern, the very basics of candlesticks, why I like to use them, and then some simple patterns to look at. And then we'll end with some Elliott Wave theory, how to build these, all the way down from a 1 minute to 30 minutes to 30 years, if you will. Okay, and trying to put that all together to form a better probability of what is likely to whatever happens, whatever market you might be looking at. All right, so let's get started here, and I'm just going to go over again the basics of candlestick patterns. All right, and this is a way to look at a price chart and look at a specific day or whatever time frame you're looking at it, and see what kind of action it is. Is it a positive day? Is it a really negative day? And then there are things that you can look at that I'll get into in terms of how to analyze it. All right, but when you start with your basic candlestick, so I'm looking at this big green bar here, and the way to look at it is if you see it's a green bar, usually green and red. You'll see black and white sometimes, but generally speaking, you can have whatever color you want. Green is for up days, red is for down days. Kind of makes it simple. It's easier to look at, okay? But within this candlestick, there are four things to look at: the high, the low, the open, and the close, all right? So you can see on this green bar, and I've marked it, this very extreme little wick, if you will, is the high of the day, okay? And right under that, there's a line where it closed. That's the close of the day. If you go all the way down, you can see this is where the stock opened, and then that last little wick down here, that's the low. All right, so if you look at it, obviously after the fact, you can see. But if you just were to look at this from how it unfolded in real time, it opened on the lows, made a slight new low, and then rallied with a really, really strong move throughout the day and closed near the high. Okay, so this is obviously a strong day. You can see the negative day down here. This happened to have a low. So this opened at the highs, okay, and then closed at the lows because it closed lower than it opened. That's why it's red. You can see it opened, and that was the high for the day. There was no wick there. So these are little things to look at in terms of how you can view a candlestick pattern. I'm going to get into some of the patterns that you look at now. And if you study technical analysis like I have, I believe I mentioned this before, there's going to be a lot of things that you might look at and be like, well, there's just a lot going on, or I don't really like the way that looks, or I don't understand it totally. Some people are like that with Elliott Wave. Some people are like that with point and figure. I can go over that later. Candlestick patterns, or your general technical patterns. I'm going to cover all of those, eventually. Okay, but what I think you'll find, and this was definitely true for me, is you'll find something that you gravitate to. You find something that your eye catches onto, and like that makes more sense to me than whatever else that someone else might be looking at. Okay, and that takes time, but I think it's important and to understand how your mind works, what kind of risk you like to take. Are you shorter term? Are you longer term? Whatever that might be. But it's important to understand everything and then narrow your focus down to what you'd like. And don't let anyone tell you what's better or worse. Some people are just look at things differently. If it works and you are successful, who cares what anybody else thinks? I think that's very important. Okay. So let's continue on with candlesticks. This is gap. I'll get back to those in a second. Okay. But what I want to focus on are some important candlestick patterns that I use. Now, when I look at the market, I look, and I've explained this many times, but I'll do it again. I look at, there's three components to my technical strategy, and that is time, which is WD Gann, okay? That is price action, which is Elliott Wave theory, which I'll cover a little bit later. and then the indicators. Okay, the indicators complement both time and price. Now, when you're talking about price, and I talked about Elliott Wave, obviously you can look at this just regarding the candlestick patterns. Okay, and there are a lot of candlestick patterns. I'll go over a hammer bottom. There's hammer tops. There's inverse hammers, inverse hammer bottoms, inverse hammer tops. There's white three soldiers. Or three white soldiers. They're the three black crows. There's there's stars, shooting stars, island reversals. You want to name it, you can go into Google whatever candlestick pattern technical book, and a bunch are going to pop up. Okay, there's plenty of content out there regarding all these different patterns. There's just a lot. I tend to focus on just a few. It keeps it simpler for me that way. All right, and I really like to combine some of these candlestick patterns with my Elliott Wave. And the hammer bottom, as you can see here, is one of them. So what does the hammer mean? And essentially within this candlestick, okay, you can see it has this long, this long wick. This was obviously the low, okay, but it represents a handle of the top, which is this hammer. So when you see a long wick or a long handle, and you have this, where all the price action, is focused on the top, okay, or bunched in at the top near the highs, okay, after a big drop, that means it's hammering out a bottom. That's the way to look at it. And if you think about it, okay, look at what this stock did. And this is Apple, by the way, real-time chart, okay, this is going back to 2018, the bottom of 2018. So we had, this was Volmageddon, for those of you when we were trading this, okay, and we had this big drop. And we had this big down day, 2 big down days before this hammer bottom. So stocks got hit, and then we made a new low, okay, but buyer stepped in and pushed the price all the way back up, creating this it dropped like this, and then it rallied, okay, and then it held at the top. Even though it was a down day, okay, you can see that it had a huge move, okay, so it's hammering in a bottom. Now what's key about is when you see this hammer formation, the next couple bars, candlesticks, are very important. All right, and so what you want to see is follow through from that hammer bottom. And this is something, again, depending on how much risk you want to take, depending on if you're shorter term or longer term. If you see this pattern, okay, this is where you can go long with a stop, below the low of the handle, okay. Or you can move your stop up a little bit, but once you see this start to develop in terms of the stronger days after that hammer bottom, that's where you can make some good money. Okay, and hammer bottoms don't happen all that often. That's why when they do happen, I like to point them out. Okay, this is going back to the low of COVID, March 23rd, 2020, and you can see I've marked it right here. Same thing. This is actually a better looking hammer just because it bunched up at the top here again. But you can see that long wick, that handle of the hammer. We knocked out, we hammered out a bottom. We had a gap up, which I'll explain in a second. Okay, with some green bars. Yes, it came back down, but the rest is history, as they say, as the stocks just melted up from there. All right. So when you have when you see this hammer bottom, that's great. Now I mentioned this gap up. What's a gap? A gap is just how it sounds, a gap between the prices. Okay. So we had this hammer bottom, and so it closed here. On the following day, on the 24th, you can see that it opened well above. There's no price action there from the overnight. Now futures, you wouldn't see that. You'd actually see that rally. But based on this price chart of Apple, you can see how this gapped up. So that's a gap. Now sometimes we'll have this what's called filling the gap. So we gap up, okay, and you can see here the market tried to retest it. It didn't fill the gap, but oftentimes what we will see is something along the lines of this. And this was big on back in the day when a lot of the markets traded in the pit. Guys or gals, traders would look at what that gap was, and they know that there would be a lot of activity there, because what a lot of people will do is they see this gap up, okay, they'll buy and then they'll put their risk or they'll put their stop below this gap. So oftentimes what you see, it didn't happen here, but oftentimes what you'll see is something like this, where the price fills the gap, everyone gets stopped out. Not everyone, but a lot of people get stopped out. There's a lot of activity, okay, and then you rally again. So this is just a short-term combination of things to watch. Okay, the hammer bottom, a gap up. If it fills the gap, look for that to be a buying opportunity. Again, you can always get back in too. Let's say that this didn't happen, right? And you put your stop here at that gap open, okay, or gap where the gap would be filled, and you got stopped out, and you're like, oh, they're rallying again. Okay, you can jump back in and then put your stop, whatever this secondary low was or high or low was. So buy, you get stopped out. Wait, this is happening. We're filling the gap. You know what? I'm seeing some strength. I'll buy and then put my stop here just below that high or low. So just a couple of different ways to think about, when you see these patterns, and they usually develop, when it's high volatile environment. Obviously the low in March of 2023 was very volatile. But something to keep in mind, something to keep track of for your own trading and investing. But hammer bottoms are one of my favorite. And then when you have these gaps, you can look to see what kind of activity you're going to get. So something to keep in mind there. And gaps happen a lot. You can see one here. This is a gap up. Okay, there's that hammer bottom. There's a gap here. So you'll see, and I marked it here too. Okay, this is a big gap. This would be called a runaway or breakaway gap. We had this move up, it gapped higher, and then it just ran away. It just broke away up to the upside without even coming close to filling the gap. Okay, there wasn't any. It didn't even break below this opening price action. It just kept going. Okay, so it's not to say that every gap up is going to have this retracement. Sometimes it doesn't, and that's obviously a very strong move for this stock. Okay, so those are just a couple of basics of candlesticks, gaps, breakaway gaps, understanding filling the gap, and a little bit how to trade that, what to look for, again on a short-term basis. All right, let me look to wedges, triangles. You'll hear them called pennants or flags. Okay, and what's important to understand about these is that they are corrective patterns. Okay, and I don't care what you call it, triangle, wedge, whatever it might be. They're corrective moves within a longer bull or bear market. I'm going to look at it in terms of a bull market, okay, just to keep it simple. But what I want to highlight here, this is gold, okay, on a weekly chart. And let me just zoom in here so it's a little easier to see. And I've marked this, again, this wedge or pattern, corrective move. So this is back in the early 2000s. We had this big move up, okay? And then we had this sideways price action. And just like I said, you have this sideways price action, okay? And then it resumes the uptrend. Pretty simple. Now, what you want to see here is that, and I've mentioned this before, is that energy is building, okay? Yeah, we had this move up. It's moving sideways. It's not breaking to new lows, but, it's just consolidating. It's building up momentum, building up energy, ready to break out. And then when it does break out, you can see you can get a nice big move. Now, there's a saying that flags fly at half-mast. And basically what that means is that if you measure, and when people talk about, price targets and measurements, I always take it with a grain of salt. It's simply to say, hey, this is what the possibility is. It doesn't mean it's going to be exact, all right? And so what a good example of that is I've taken from 1999 all the way up until that high in 2006. So, that's 6-7 year move, okay? And I've marked that with around $475, all right? So we rallied, all right, and then we have this flag, okay? Well, if it's at half-mast, that means it has essentially another $475 to go. Now, look at how this played out. And again, this is a real-time example, so it worked. I'm not saying this is going to work to the dollar or to the penny every time, but what I am saying is just a measurement that you can use. So if we zoom in here, you can see, let me let me highlight this a little bit more, make it easier to see. So we had this breakout. This was the $475, 6-7 year move all the way up to this high. We had this flag or corrective pattern, and then I just took that 475 and measured it from the low of this flag, and you can see it targeted this high in 2008. So another year and a half, 2 year move that was flying at half mast. The other half targeted the high, and then we had another correction. Now, it didn't mean it was the high. Obviously, gold kept going. Again, I'm not going to say that this is a perfect science. It's simply a possible or probability of what could happen based on these flag corrective pennant type patterns. Okay, you can also measure the length of the flag or length of the pattern. All right, so you can see here call it $230. I measured that from the breakout point, okay, and this created this high right here. So you can see how there's a little bit of a mathematical, pathway to how do you get these targets. It doesn't mean that is going to be the exact high or that low. It simply means that the market is going to respect that as a temporary high or low. Something to think about. Now, when we look at gold now, and I've covered this a little bit, is we're seeing this flag pennant pattern happen right now. So we had this move up, we had this breakout here in March of 2024, and now we're consolidating. Okay, we had the high in late April in gold, low in stocks, and now we're consolidating. So what half-mast is this? The half-mast from here, and this is something that definitely to think about, okay? So this is a $1,417 move. That's a pretty big move, obviously, okay? If this is flying at half-mast, does this mean that we're going to have this type of move? Check this out. And we're looking at $4,500 in gold. I can't rule that out, okay? Let's take it down a notch, all right? Let's not get too crazy. Let's take the length of the of this pattern, okay? Let's take the mast, if you will, okay? $543, okay? And then measure it from the breakout point. Now we have to see what the breakout point is going to be. We almost had it here, but let's just say it breaks out. Let's say August, September, something like that, okay? That gets you $543. That gets you to $4,000. So you can see how, again, this is a conservative estimate. This is more an aggressive estimate in terms of how to look at these things. But so long as we don't see support break, okay, this uptrend holds true, and we see this wedge, flag, pattern, corrective move, build that energy, and then explode higher, we have some measurements to look at for where gold could possibly go. I think that's pretty interesting. All right. Lastly, I'm going to talk about Elliott Wave, and obviously this is sort of my bread and butter. It's again, when I look at price action, this is what's most important to me, and the reason I like it, and I've talked about this many times, but it's worth repeating over and over and over again, is that it is not just a way to look at the market. It is also a trading system. It is a risk management system. So when you identify these waves based upon the rules, 5 waves up, 3 waves down, okay, that gives you an indication. I think this is going to be a wave 3 or a wave 4. If something happens in the market that breaks a level, that tells you to start over again. Now, does that get frustrating for some people? I get it. I understand. But welcome to the world of trading. Welcome to the world of taking risk. Okay? Never be afraid to get out. Never be afraid to get back in. Understand when you're wrong. But this is also a great indication of, if you are wrong, okay, what is the market telling me? Don't let it get you down. Let it say, I was wrong. All right, but now what's going to happen? Should I turn bullish? Should I turn bearish? Should I stay and do nothing? Okay, so always look at it from a positive mind frame. I've been doing this for a long, long, long time. I've been in the newsletter business for about 8-9 years, and I see, people get frustrated when things don't go exactly to plan, but that's part of the plan. And I think it's very important to say, all right, what is the market telling me? How do I need to react differently than what the market is doing rather than what I thought it was going to do? And that's what Elliott Wave allows you to do. That's why I focus on it so much, okay? So, again, 5 waves up, 3 waves down. Now, what's important about this, and this is the Dow Jones futures chart, and I highlighted this to subscribers when Europe and the U.S. came to an agreement last week. And, what I looked at was this was a kind of at least a short-term sell the news event. So from July 16th, I have this low, and you can see 1, 2, 3, 4, 5. Okay, great. Now within that, I was tracking this, and this was that Sunday night when futures opened. The deal was announced on a Sunday. So you can see here, this is a shorter-term Elliott Wave, 1, 2, 3, 4, 5. So I just want to focus on this move right here. So you can see I have this wave 5 from all the way down here. This is the larger move, 1, 2, 3, 4, 5. Now within each wave, this is what's important, are smaller waves. Those smaller waves make larger waves, which make even larger waves. You can look at it. So a lot of people will, how do you spend your day? What does it all look like? There's a lot of different things, but mainly what I want to focus on, especially when it comes to, the stock, the big indexes and the sectors or important stocks, I have my 1 minute, 1 day chart, and I'm tracking what is happening all the time because that helps me build the building blocks for the larger moves that I'm anticipating. Okay, that's where I spend the majority of my time. Is it time consuming? Absolutely. Does it take hard work? Absolutely. Does it take a lot out of you? Absolutely. But that's the name of the game. That is what separates long-term consistency, long-term profitability from just saying, oh, well, I'm just going to hold on to stocks and, I don't have to worry about anything. In terms of a trader, you can't do that. Okay. You have to be on top of the market all the time. You're in the foxhole every day. And I think Elliott Wave gives you a better probability of success in how you look at the market and assessing risk. So again, each larger wave contains 5 smaller waves and 3 waves. It's all 5s and 3s, 5s and 3s. And once you get going with it, once you understand the rules and what to look for, and you'll see these patterns develop again and again and again. I do all the labeling because I want to show everyone, but you do it enough, you'll just look at a market and you won't even have to label it yourself because it'll be ingrained in your mind. Okay, so but let's look here again. 1, 2, 3, 4, 5. All right. So if each larger wave contains sub counts of with smaller waves, can we do this with wave 3? Absolutely. Let's do it. Look, 1, big shot up, big move down. Now this is where the rules of understanding Elliott Wave. Wave 2 has to stop above the low of wave 1. So you see a big move up. Oh, okay. There's some choppiness going on. Let's label this a wave 2. And then once this price action breaks above this high, wow, that could be a wave 3. And that's what we got, okay? So wave 3 had a nice big move, all right? We get one more correction in a wave 4, and then we have the wave 5, and that creates the whole move. Now, and then ABC, right? This was a choppy ABC, okay? And then we get that 5th wave move. Look at wave 2, ABC, right? Choppy, okay? That's 3 waves. This is 3 waves. So this is a perfect real-time example. A lot of people like to draw stuff on pieces of paper and say, let's use real-time examples because you're going to be trading real-time. All right. 1, 2, 3, 4, 5, real-time example. And now we had this correction. Okay. And so when we look at a bigger time frame, you can see here, this is going back to May. I have this 1, 2, 3, 4, 5. Now, it's also important, I mentioned at the start how, I use technical indicators like the RSI here to gauge to kind of put it all together. You can see here, price made a slight new high, okay, but the RSI didn't. This is negative divergence. Okay, that tells me that there's a little bit more probability that, this is a wave 5. Now, we also have to incorporate time, okay, so we can get into later this week. I've mentioned April 5th and 6th, and then into next week, April 12th, 13th. These are specific days within this 2-week window that I think are going to be more important than others. But, when we're talking about a wave 5 here, to me, again, this just means patience. It doesn't mean that, I want to just, get crazy in either direction. We can expect a wave 3 correction. That's where I'm looking to how is it going to be violent? Is it going to be volatile? Or is it going to be something like this, back from mid-May to June, where there really wasn't much? That remains to be seen, but as I've said recently, both to 10 Stock Trader subscribers, and last week on the show, to me, this is a situation where you're probably going to want to be patient. All right. But this is a great real-time example of Elliott Wave, how to utilize it, what to look for, and again, I encourage you to do this on your own. Okay. I will go into this one day. You can see up here, 1 day, 1 minute, and I'm tracking all this. I want to see, all right, how is this shaping out? Can I label those 1, 2, 3, 4, 5 ABCs and then start building it up to where you get to this, right? And so, and that's where, I want to see how this whole thing shakes out. So, good coverage this week on candlestick basic patterns, gaps, hammer bottoms, and tops. Those are important to incorporate. We looked at the wedges. We looked at, wedges, flags, half-mast, targets, what could happen with gold, okay? So I think there's going to be enough activity over the next few weeks to get excited, but I think patience right now is going to be important. But I wanted to highlight some of these, other educational references, if you will, and encourage you to look at the various aspects of technical analysis and how you can utilize it in your own investing and your own trading. Thank you very much.